Hi, everyone. Welcome to Reimagine 2020. I'm Artur, one of your hosts, and today I have with me Evan and Manuel from Ampleforth, the protocol token that completely took DeFi by surprise this year. So extremely excited to hear more about, honestly, what the hell is Ampleforth and what these guys have in plans next. Welcome, Evan and Manuel.
Hey,
Hi.
Thanks so much for having us.
So I guess let's just kick it off. How would you guys, to the average, I guess, crypto adopter, how would you guys describe what is Ampleforth and what are you guys aiming to do?
Yeah, I can take this one real quick, Manny.
Yep.
Really, Ampleforth is a protocol, and it produces a token called the Ample. And the Ample is a cryptocurrency like Bitcoin, except that it has a twist to it, which is it receives price exchange rate information from oracles and will automatically increase or decrease the quantity of tokens in user wallets proportionally based on this exchange rate. So the motivation here is to create an elastic supply currency that's non-collateralized, that cannot be redeemed for any sort of traditional asset, but that can act as a building block for the future of decentralized finance. And we can get into that a little bit more. Manny, is that roughly how you would describe the Ample?
That's kind of how I would describe it. I think it embodies a lot of ideas that have been around for many decades about a rules-based base money that could adjust supply, and so it really represents, I think, the realization of ideas about synthetic commodities and sort of rules-based monetary systems.
And maybe can you tell me a bit about yourself? How did you even, how did you come to sort of end up where you are today?
Sure. Yeah. So when we got started, I mean, I had been introduced to Bitcoin long ago. I was a skeptic. Understandably, this is 2009. I thought it was an interesting idea that would never really work because, well, it seemed out the gate very inefficient. It seemed like the type of system that would get more and more difficult to scale over time, and it seemed very difficult to use and was kind of clunky. And so I couldn't really imagine why people would suddenly agree that this sort of thing had value simply based on the fact that it was scarce. And then I kind of forgot about it for a while, but a couple things stood out in the background of my mind. One was that it made these huge design concessions in the name of censorship resistance, right? It needed to be kind of resistant in that way. And eventually it struck out in my mind as being important that they were able to create anything that was scarce at all in a purely digital context, because that's a very difficult thing to do, right? One of the qualities of digital information is that it can be copied and pasted again and again. And so the creation of any amount of scarcity was special. And then eventually around 2017 or so, Brandon and I, we sensed a little bit of heat following the launch of Ethereum and the rise of, all sorts of new projects, and people were buzzing and money was being made. And we were really confused as to what was really going on here. And so we just started to read white papers on a weekly basis. And every time we read a paper, we were just like, well, why does this require blockchain? Why does it require censorship resistance? I thought that was all about counteracting a sovereign monopoly, and the service you're trying to disrupt, delivery coffee, doesn't have a sovereign monopoly. Anybody's free to compete. So that didn't make sense, but people kept on kind of contributing to these. So we just kept on asking these questions and kept on reading these papers. And finally, we kind of came to this conclusion that, in fact, it doesn't make sense. You keep digging, and it really doesn't make sense. And that the most salient use case of blockchain technology at the time, and I still believe today, is for the creation of new monies. I mean, that's the only thing that would call for such great concessions on usability and scalability in the name of censorship resistance, because there are very few sovereign monopolies. There are many free market monopolies that don't require blockchains to compete against. And then there are very few sovereign monopolies that do require blockchain technology to compete against. And then once we came to that realization, it was more of a question of, well, what's wrong with money? Well, Bitcoin has this fixed supply policy. That always seemed kind of weird, because we'd heard there was this thing called the gold standard, and there was this thing called Bretton Woods, and we moved away from fixed supply, right? For reasons that at the time I didn't fully know off the top of my head, but I just kind of suspected, okay, what was wrong with that? And so we just kept tugging on that. And eventually kind of came to this realization that, well, there isn't a whole lot wrong with things like gold that are fixed supply. And there isn't really a whole lot wrong with Bitcoin, as a fixed supply asset, except when you try to build a financial ecosystem or banking system on top of a fixed supply asset. And somewhere along the way, we had designed this kind of, I don't know, almost like stable coin, right? It wasn't quite a stable coin, but it had this elastic supply policy. It also automatically would kind of capitalize a reserve, right? An algorithmic reserve to buy back things when price goes down.
Can I just there?
Yeah.
What is the problem? What problems do you encounter with a fixed supply when building on top of a fixed supply asset?
Well, so that's where Manny comes in really handy, because he's the one that fully educated on this, and I'd love to hear him talk about it. Although I've done it many times, I just want to hear it from Manny.
Yeah, so my background is slightly different than Evan. So I originally studied mathematics. I then decided to I kind of fell in love with financial history through some courses that I took at Harvard, actually, with Neil Ferguson back when I was an undergraduate. I then went back to grad school, and I got interested in Bitcoin around 2013, 2014, when I took some courses on sort of the constitutional law of money with Christine Dasson. She's fantastic. She wrote a book called Making Money, which I think everyone should read. And so I've been sort of thinking about financial history for a long time. And so when people talk about, say the Bitcoin standard or the gold standard, there are issues that are inherent in that system. I mean, even if you use, say, silver. One of the key problem, I think, with metallic reserve systems is that you are open to a lot of shocks, right? And oftentimes they're not necessarily shocks about the change in supply in the base metal. So, if you read Richard von Glahn writes history of imperial China. So the Chinese experienced a deflation, an inflationary era that allowed for monetization, and in a deflationary era. And a lot of this was driven by the price of silver in Europe, right? So silver would leave, and that would lead to deflation. And so that contract suddenly became more expensive. In 1934-35, the US passed laws around silver production, which shocked, again, the Chinese system, which was based on silver. So that forced them to go into a fiat system. So a lot of the time, these are quite problematic. Though I would add, one thing is that, the properties of these metals don't change over time. They have remained constant as far as we know throughout the age of the universe. But the type of money that can be built on top of a particular type of base money, like gold or Bitcoin or, hopefully Ampleforth, that is mediated by a whole layer of institutions. And so those are also very important. So, but in short, I think that the type of money and institutions that you can build on top of a fixed supply asset like gold is limited by, in fact, that the fixity of it. And I think the real distinction that people have in mind, like why they're drawn to Bitcoin or gold, is not that it's fixed, but rather that it's non-discretionary, right? It's not within any one actor's power to change that supply. And I think that's the thing that's important. So the supply can be elastic, but as long as it's rules-based and no one can change it at will, I think that's actually what matters the most.
Yeah, and I think if I were to describe it maybe in a more naive way, the problem is that a system that's built on top of a fixed supply asset, as Manny suggested, can easily be destabilized by sudden shocks. And a recent example of that was under the Bretton Woods system, where the dollar was redeemable for gold by central banks and foreign governments. Just as it is today, the dollar was a global reserve currency, and there was a great deal of demand for it, right? And as a result of that, right, it became very difficult to keep up with that demand in obtaining gold. And what happens in that scenario is the price of gold goes up. And folks believe that the gold nugget that they have today maybe buys you one refrigerator, but it could buy 2 refrigerators tomorrow. So they hold on to that gold, further restricting the circulating supply of gold. And this is a self-reinforcing cycle that can lead to a deflationary spiral or a liquidity crisis, right? That shuts down the entire machine that's built on top of these fixed supply assets. And ultimately, that's why we had to cancel redeemability under Bretton Woods. And a similar fate might take place if we were to construct some sort of banking system or ecosystem on top of a fixed supply asset like Bitcoin. And that's just one example of it. But this sort of kind of rigidity in supply is not very robust. You can imagine that if you and I were to enter into a bet, and Manny and I said, well, if the Warriors make it to the finals, I'll pay you 1 Bitcoin. Maybe he's really happy with that bet, and I'm really happy with that bet. But he decides that he's just going to go sell the option of that contract to someone else, and that person packages it and puts it into some other kind of basket of contracts and sells it to someone else, right? Come the time of finals, let's say the Warriors do make it, and I'm on the hook for 100 Bitcoin, and I thought it was going to be, I thought it was going to cost me $100, but it actually cost me $1,000, right? Because the price changed. I default. The person he sold the contract to defaults, right? And it's packaged in this other kind of grouping of contracts, and you get this cascading destabilizing effect. And this is really well documented by folks like Friedman in his writings about commodity reserve currencies. It really just comes down to a problem of supply inelasticity, and in particular, the cost of production of things like gold. Just because there is gold to be mined, there certainly is a fixed supply of it, but we can't even ramp up the rate at which we're mining gold as needed very cheaply. And we certainly can't ramp it down very cheaply. And that's why fiat money was such a big breakthrough, because it was cheap to produce, but expensive to counterfeit. And that gave it the elasticity necessary to construct a robust ecosystem. And Manny, I'm sensing that you might have something to add here as well.
Yeah, I'll add one more thing before because I think Artur might have another question. I was just going to say, when you have a fixed space, the way that you meet the demand for money is by building institutions like fractional reserve banks on top of it. And in some ways, that's what people were reacting against in 2009, and definitely when Satoshi launched Bitcoin. And so it's a little bit ironic that people are advocating now basically the recreation of that system, but in the decentralized way, when there is an opportunity to do something that's truly novel, which is a completely rules-based kind of elastic supply token, which is impossible in the real world. Well, not necessarily impossible. This was I mentioned this before, that this was kind of theorized in the 60s by James Buchanan, who I think wrote something like, if only we could have a type of money that was managed by some system of supercomputers where it would update your bank accounts, but the passwords and codes to change that program had been destroyed, so it was beyond the reach of modification by the Federal Reserve. So it just took another 50 years for it to be 57 years for it to come true. But I think people had been thinking that this would be kind of the next step. It's just technologically we just weren't there.
Mm-hmm.
Yeah.
Got it. I mean, quite a lot to digest there, honestly. But so just kind of like circling back or asking some questions. So where Ampleforth is the where it's like game changer nature kind of lies is it's the elastic supply. Is the goal still for it to be a store of value as are gold and Bitcoin and so on? Is elastic
in a
supply
way,
then
yeah.
also does it make it a better store of value?
In a way,
yeah. I mean,
sorry.
Go ahead, Evan.
I'll just go real quick. I was saying, when we designed the Ampleforth asset, the original motivation was to address the supply of fixed supply assets as simply and as directly as possible. And that's why the Ample was designed to be non-dilutive, in the sense that when we increase the supply of tokens, we do so proportionally across all wallets. For that reason, it shares this quality with Bitcoin where if you own 1% of the total supply, you will forever own 1% of the total supply, even if that total supply increases tenfold. You'll simply have 10 times more coins. And for that reason, it's an equivalent kind of store value. And like I said, the design was such that we want to address the problem of fixed supply assets. But upon further analysis, and this is something we work really closely with Manny on, we came to this belief that the manner in which we adjust supply, because it accrues directly to users, would introduce a novel movement pattern. And this is because gains and losses can't easily be determined entirely based on price. You might buy Ample at $1 at a $10 market cap, and then Ample grows, 10x to a $100 market cap, right? And you might sell Ample again at $1, but you've really 10x'd your holding, right? Just because the price per coin remained the same doesn't mean you haven't gained or lost. And this would kind of break a lot of the systematic trading that was going on that I think is the root of the hypercorrelation behind a lot of these fixed supply assets. And so what we realized upon further analysis that this protocol might give rise to a different step function like movement pattern that could eventually decouple from assets like Bitcoin and Ethereum, which is very important because as you probably have felt or know, many of these assets trade in lockstep with one another. And therefore you can't really diversify cryptocurrency holdings by holding a basket of assets because they all move up and down together. And in fact, doing that might actually just increase the beta of your holding. And diversification is really important. It's one of only 2 commonly used methods of risk reduction employed by kind of financial engineers across the world. The other being hedging, of course, which we see a lot of in crypto, but not a lot of diversification. So from some more ideal base money, we also realized this potential side benefit of it's just going to be novel and move differently and therefore be used for constructing baskets. And the 2 kind of consequences that naturally follow from that are that, like, well, yeah, one, it could be used to diversify, and that could be great just for holding these new precious metals in baskets, and that could make it. It could also be an interesting building block characteristic.
I was just going to add a little bit more on the building block, but yeah, go ahead, Artur.
No, my question was going to be that do I understand correctly that it's essentially a kind of a monetary system that just scales better, scales naturally, and scales on a protocol level, that as there is more demand for the money because it's programmed to maintain a certain sort of, let's call it value, then it's sort of in a non-dilutive way, it expands the supply. Is that kind of more or less correct?
Yeah, I would say that's actually the best interpretation I've heard so far. The price target is really kind of the threshold for measuring whether there's excess demand or a lack of demand, but it's really about, in fact, triggering an expansion or sort of decrease in the supply of money. So
okay, so my next question is that, and as we sort of stated that, or as you guys sort of like stated, was that the best way to measure it is not the price, but it's the sort of like the market cap, or then it's still intended to be used as money, right? So then let's say, how do I now, let's say I go to Apple, I want to buy an iPhone, what will it be denominated in then?
So, yeah, so there's a couple interesting things. Number one, right? So remember under Bretton Woods, where we had gold as a base money, gold was money. It certainly is money, but what was being circulated to pay for goods and services and wages was dollars, right? So the dollars were actually used as what most people commonly view to be money, right? To transact for coffee and such. And that was built on top of the base money. And so there are many kind of interesting definitions of money, none of which are actually complete. It's a bit of a spectrum, but a base money is a building block for a system that may very well produce yet another money that becomes the commonly used media. And a recent example of this that might be easy to relate to in the DeFi world is something like MakerDAO. So if you remember in the early days, MakerDAO was collateralized entirely by ETH and then eventually basic attention token. Those were the base monies of that monetary system. It's kind of a banking system, actually. It's less a base money. The MakerDAO is more like an attempt to decentralize a central bank, right? So it's more of a bank. And of course, the output of that system is DAI, which is the stable coin to be used, I think, for goods and services or as a base, trading pair token for the types of use cases that people commonly equate with money. And then, of course, what we saw was the collapse of, that system, at least briefly, on Black Friday when prices tanked. We saw all sorts of things happen. Well, the collateral base itself was hyper-correlated. And so they had to introduce, USDC as a form of collateral, which seems kind of ironic because you don't need, dollars to be the solution to your problems with crypto. The whole point of crypto is to kind of create something that's disconnected from, the existing financial system. They also face a liquidity crisis, which is not unlike, things that remind me of Bretton Woods, in the sense that, at a time when prices were falling on ETH, people really demanded a lot more DAI. And they might have been doing this for various reasons. One of the reasons could be because they want to retreat into a safe store of value. But I think the predominant reason is they needed DAI to close out their debt positions, right? Because the output of, you borrow money and that's denominated in DAI, and then you do something with it presumably, but you have this kind of, obligation to pay it out. Suddenly prices are falling, you're afraid of auto liquidation, and now you want more DAI, but the system doesn't deliver you more DAI. So at a time when people really needed that DAI, the actual natural incentive of the system was for people to buy the DAI that they needed so that they could close out their debt positions, therefore decreasing the circulating supply of DAI. That's kind of the opposite of what you want. I think what you really want is a tight coupling between supply and demand. When the demand for what you want is high, you want supply to increase. When the demand for what you want is low, you want supply to decrease. And what we saw there was a little backwards. The demand for DAI was high, but the incentive system was actually destroy the circulating supply of DAI because everybody wanted to close out their debts. And so in that sense, like just reiterating here, there are multiple levels of money. There are the base monies of the MakerDAO system, which were ETH and basic attention token. And there was the output money, right, which might be what you would describe as this commonly used media of exchange, or intended to be a commonly used media of exchange, which is DAI. And with Ample, as with all base monies, they're kind of sitting at the bottom level, right, where this is an irredeemable asset. If it can be a very great building block for a financial ecosystem, that would be a very successful outcome for us. To ask that it also is both the building block and the output that DAI was, that could directly challenge something like the dollar, is asking quite a lot out of any base money, and it might be asking too much. Manny, I know you have some thoughts on this as well.
Yeah, so I was just going to say it's been quite a while since we used sort of base metals as the actual circulating money. And even when, at least in Europe and in China, when people did do that, they still needed sort of subsidiary currencies, copper tokens and so on, that were supposed to circulate at a particular peg with the main currency that you used to pay taxes. So it's quite hard for it to, as Evan said, to have a bare bones infrastructure where the base money is also the circulating media. And I think the reason that Ampleforth is useful is that it's quite plug and play, right? If you wanted to create a series of contracts that somehow kind of abstracted out the price volatility, you would need the contract writers to kind of incorporate it, maybe reference oracles. On the other hand, if you go to a lending protocol and you just borrow Ample, I think it was Brandon's phrase was they borrow like stablecoin, right? You just borrow, you create a debt contract, says you owe 100 Amples and you pay 100 Amples in the future. And that's a lot easier than trying to like incorporate references to like current market spot prices at the time of redemption and so on. So it kind of abstracts out a lot of the complexity to allow much better types of contracts in decentralized finance. And so the idea is that it would just be a plug and play, I think. So it brings that functionality and saves people a lot of work.
Without becoming a bank, without introducing a balance sheet that manage assets and liabilities, like Bitcoin, the Ample system only maintains pretty much like the money that you have, right? And it allows you to transact between peers, much like Bitcoin. There's no credit, there's no debt. It's just a system of accounting that says, look, Manny's address 123 has 100 Bitcoin, and he has the ability to send it if he wants to. That's it. No banking involved. And so, yeah, it does become a much more natural building block for a financial ecosystem in that it supports dumb contracts is what you could call it even, right?
If we imagined actually a bank, for example, where you have a fixed base and say you were creating credit on top of it, you know, people have giving you deposits and you're lending it out. If we think about free banking, when banks would create their own notes and circulate them out, I mean, that's kind of the world of DeFi, right? It's the world of 19th century America, free banking. It's crazy. A lot of these blow up. It's risky, but there's a lot of different types of circulating money. As the demand for these notes increase, right, the reserve relative to the general portfolio would go down, right? And so it creates this risk for a run, right? Because if people want to redeem, not everyone's going to be able to redeem, and you know, you have this constant issue of bank runs that would happen all the time. On the other hand, if gold had the properties that Ample has today, right, that means that as there was a demand for notes, the quantity of gold in the vaults would multiply, and so the reserve, you know, would not be wildly lowered relative to the general sort of outstanding portfolio of loans. So you can, you know, you can mitigate some of that risk in that sense. But you know, that's one of the ways of thinking about, you know, what the benefit here is.
Right. So I want to get into the sort of like the next point, but before that, I just want to so do I understand that correctly? That let's say in a hypothetical world, a decade into the future, the entire financial system runs on an elastic supply powered by Ampleforth, then the actual payment token that I would be using to buy this exemplary iPhone, because Apple still obviously exists in the future, would not be the current Ample token. It would be something built on top of the protocol. Or did I understand that correctly? That the current
yeah, I mean, in a way, I mean, functionally, you could kind of think of it as this. Like we kind of imagined, well, under Bretton Woods, it was a system similar to what you described, where, you know, like I said, dollars were redeemable for gold, but mostly people were paying for goods and services using dollars, not gold. We asked ourselves what would happen if, you know, under ideal conditions, we were to substitute gold for Bitcoin, right? So what if, you know, look, using the technology we have today, we replace gold with Bitcoin under Bretton Woods? Would we have faced the same dilemma? And the answer is certainly yes. I mean, I think Bitcoin is perhaps even less elastic than gold, because at least gold responds to the marginal cost of production that changes over time as, you know, function of demand. Though it's very, you know, narrow in its band, it does change a little bit. And you know, part of the motivation for this design, at least in my mind at the time, was like, well, you know, could we design an asset like Ample that could have been a good swap for gold under Bretton Woods and allowed it to continue existing on top of the base money, right? And the answer was like, yeah, much more likely to have worked out that way than swapping gold for Bitcoin. And so, you know, in a way, like, you know, we can answer that question that you're imagining 10 years in the future by just kind of looking kind of 40, 50 years in the past. Does that help?
I think so. Yeah. All right. So I guess next thing I'd be really interested to hear is that, so obviously I think this year you guys have, you know, Ampleforth has reached some form of mass adoption within the crypto space. You managed to get basically most of the major exchanges to integrate the rebase contracts. You've turned the rebase into something that is, you know, so incredibly widely known and used. So I guess, like, you know, elastic finance is no longer an unknown. And my question is now, like, you know, and you guys have unveiled the sort of the next steps in the roadmap, which is it's quite a mouthful: multi-chain elastic finance. What is that? How do we sort of so and I think Manuel, you mentioned as well that, like, you mentioned that if I borrow 100 Ample, so obviously my question would have been then, is the loan contract and I'm jumping ahead a little bit, but is the loan contract also elastic, or
well, so yeah,
maybe
normally
you guys can just,
you would have to do that.
Mike to you.
Yeah. I mean, just to answer this question, and then very quick, and then I think Evan can tell you a little bit more about the roadmap. It's you know, the idea, if you write a contract and say, you know, I owe you know, Artur 100 Ample, And so, I borrow 100 Ample from you, the demand for Ample goes up, and a month later, my wallet has 200. I would still pay you back 100. It's easy to denominate and it's easy to understand. And that's basically what I meant by that it borrows like a stable coin. Like, you don't have to think about the price changing, and you're not incorporating that risk in there.
Yeah.
Necessarily.
In a way, it is kind of plug and play. So let's say Ample is made available on something like Compound or Aave or Cream, right? In a system like that, if say I lent 1,000 Ample and you borrowed 500 Ample, the 500 Ample that I kind of input into the system that hasn't been lent out, it's subject to rebases. So it can gain and lose value based on those supply changes, just as though it was in my own wallet. But your debt obligation as the borrower of Ample is to pay back 500 Ample, not the discounted future value of 500 Ample subject to rebases over time, but simply 500 Ample at the time you want to close out your position. And because Ample has a cyclical price, that at some point it'll just be $1, and in fact, you might want to like borrow Ample when it's greater than $1, because say you're borrowing Ample and it's trading at $1.50, you sell that Ample, you go do some other thing with it. That one day it'll come back to $1 and it'll actually cost you less to pay off that loan. If it dips beneath $1, you'll have this incentive to actually go ahead and buy Ample off the market and close out your loan position, because it's the cheapest you're going to get it. And so it has this natural counter-cyclical nature to it, where it incentivizes kind of selling above the target and buying below the target as well. So that's just one example of how that coin naturally plugs into a lend borrow system in DeFi today. And so kind of to answer your question about the multi-chain elastic finance, internally we just call it EFI because that is a mouthful. EFI is a little bit easier. That's us building up the stack, because while it is the case that we plug natively into services like Uniswap with very little integration whatsoever, that doesn't mean that it optimally utilizes the qualities of an elastic token. And so really elastic finance is building up the stack, looking at these automated market making platforms like Uniswap and saying, well, what kind of special purpose automated market making platform can we build on top of an elastic supply asset? And what sort of special purpose lend borrow platform can we build? What sort of special derivatives can we build? And what sort of special cross-chain considerations might exist, right? And there are just so many examples. It's almost like the Ample is so different compared to these the first generation of cryptocurrency assets. They were all, whether you were creating a web browser like Brave or Basic Attention Token, or you were creating a decentralized global computer like Ethereum, or a digital gold like Bitcoin, you had this fixed supply asset, and pretty much the asset moved up and down. They all just moved up and down together. The Ample was actually the first different asset that entered the system. While all of those things I just listed sound very different, in the marketplace, they started to behave pretty much the same way. The Ample it is actually the first truly different asset in that it just doesn't move the same way in the market. And that kind of novelty has second order effects as well, like on some of these systems that we create, like what we described with the lend borrow system. And in the case of like an automated market making system, well, what do you know about Ample that you can make use of? You know that it's supplied just once a day, every day. And the manner in which it adjusts it just submits this number, right, which is the change in total supply. It's an assigned integer. It's either a negative or positive number, but encoded in that number is the knowledge of the previous 24-hour volume weighted average price. And so from that, not only where the price is, but also where it ought to be, because it has this price target. Not only where it is, but where it ought to be. It wants to be at 1, it's not at 1. Maybe it's higher than 1, or, it ought to be at 1, but it's lower than 1. And from there, you can kind of articulate a much more nuanced and efficient bonding curve, right? So as you know, with these swap exchanges, there isn't real price discovery going on. There's no order book or matching engine. It's not a representation of what people are willing to pay up and down the spectrum for a given asset. It's just represented by like two pools and the relative height of these two pools. And the only thing you can do is swap between them. And when you swap, the balance of these pools changes, and the price is actually inferred from that ratio of balances. Now, with the Ample, you're getting a free extra piece of information, which is like, you know, its previous 24-hour volume weighted price. And by an understanding of the protocol, you also know like where it is and where it ought to be. And one of the things that these market making protocols don't do today is they don't really modify their liquidity or their slippage based on how much volume there is, based on how much, you know, demand there is. It just it exists as a static pool. Whereas like in an informed exchange, right, you might see things like, okay, well, there's a huge swing in volatility. We're going to thin the books. That's what any market maker would do. It's like, we're going to get out of the way because the market's still kind of trying to discover its new equilibrium. Let's not throw up so much depth, right? Because we don't know where it's going to land. And so things kind of thin or thicken. Like if the market's really confident and things are consolidating at a number, you would imagine the plus or minus 2% depth to increase, right? On these kind of automated market making exchanges, so to speak, that depth doesn't change as a function of volume. It has no knowledge, but on top of an asset like Ample, you do have knowledge. You know whether it's happy and at an equilibrium because it's at 1. And you know it's unhappy and still kind of trying to find an equilibrium, either upward or downward, because it's either greater or less than 1. And so the curve can be articulated in such a way that, you know, the plus minus 2% depth kind of changes as a function of where it sits on that curve. And this is not unlike what Curve, the project, does, right? Because it knows that it's exchanging from stablecoin to stablecoin. It's a bit flatter around 1, right? Around when, you know, the total number of coins combined, if they were all the same, you know, value, you know, is how they designed their curve and appropriate for that exchange than Uniswap is, because just because, you know, there's a whole lot of this one asset, not a lot of this other asset, doesn't mean they shouldn't trade at $1, because both assets might be redeemable for dollars. And so that shaping mechanism takes into consideration the underlying asset. And so by doing that, we can create a much more efficient AMM for elastic assets, right? And there's just countless examples of this. It's almost like novelty input begets a novelty output, right? So, you know, everything was once the same. We put all these things that are the same into these really creative systems, and the outputs are just transformations of the inputs that are the same. And now there's an asset that's different. And so the transformation of these assets is also going to be different. And that variety is very, very important, particularly to people who think, you know, in terms of traditional finance, right? I mean, Bitcoin's randomness, its non-dilutive randomness, if you will, is what makes it so enticing to people who are kind of more traditional asset management folks who think in terms of portfolio theory. And for that same reason, amples are kind of really interesting, right? Non-dilutive randomness is being introduced as well.
Right. And regarding AMM, so you discussed it in detail just now, and you guys recently announced your own like a smart pool that that eliminates impermanent loss on these elastic assets. How?
So that's another really just crazy thing that comes for free because of because of the extra information signal that Ample has. The way these pools work is they're constant product invariance, right? So with Uniswap, you can figure balance 1 times balance 2 is an invariant, and the ratio of these balances determines the price, right? Balancer itself just kind of extrapolates that to create a swap exchange that can support pools of more than 2 balances, up to 8, I believe, right? So it's like balance 1 times balance 2 times balance 3 is an invariant, right? Well, it's kind of like, I mean, imagine it's balance red times balance green times balance blue is an invariant. Well, that means we could also do balance red times balance red again times balance blue is an invariant. That's the same thing as saying balance red squared times balance blue to the first power is an invariant. And so all of a sudden you're introducing this parameter, which is the exponent, right? You can normalize these exponents by designing them such that once you've added them all up, they sum to 1, so you don't get kind of carried away. And that introduces this kind of weighting parameter that allows you to say, well, rather than a 50-50 pool, I can make it an 80-20 pool or a 66-33 pool, right? However, whatever distribution of weights I can imagine, I can apply to this pool. And that's kind of like rebalancing a portfolio, saying I want to be ETH heavy, Bitcoin light, you know? But with Balancer, what's really cool is they also allow smart pools to be formed, which is just this thing, except for you can actively set the weighting if you're the owner of this smart pool. And when you mix that with Ample, you get something really special, because Ample can systematically update the weights in these smart pools, right? So based on that rebase information, you can perfectly offset the change in supply with an adjustment commensurately in the weights of these pools. And that kind of makes this impermanent loss thing perhaps even less permanent, right? Because you know that Ample has a cyclical price; it'll eventually return to one or hover around one, and you can offset these changes in supply with changes in weight. The combination of those two things allows us to kind of all but eliminate impermanent loss without introducing an extra oracle. And so it's just kind of, again, we're piggybacking one new piece of information, which is this coefficient of expansion. It changes only once a day, and it tells you, how much we're increasing or decreasing supply by. But encoded within that, it's also telling you what the previous 24-hour volume weighted price of the asset was, because that was the input that told us how much we should increase or decrease supply by. When you just continue propagating that information forward, and you do so in a rules-based fashion, because it's a rules-based protocol, you can kind of eliminate some of these problems.
Yeah.
And so that's just kind of a clever, nice kind of match. And we credit Brandon for seeing this early on. And I'm sorry that he's not here, but that was pretty cool. And there was just all sorts of other cool stuff that ends up happening when you kind of existing DeFi ecosystems or reimagine DeFi ecosystems on top of Ample.
And is this pool is this smart pool live already, or is it coming?
If it's not live already, it probably will be live by the time this video comes out, because it's supposed to come out today. So we just kind of made the announcement. It'll be public and live and ready. I don't know if the Balancer team has made it available through their UI yet, but the stuff underneath the hood is all ready to go.
That's awesome. Congrats. And I understand the first pool is USDC and Ample. And as you described, that it controls it eliminates impermanent loss. Is it actually kind of like sort of like a Trojan horse to then start, that for the next asset to be for the next pool to have, instead of USDC, for example, ETH, or basically for Ample to gradually become like the quote currency? Or is that the sort of the strategy?
With the smart pools, there's quite a lot that we can do. I don't know that is overtly the strategy, but the broader strategy is we want Ample to be a value highway. The more liquid it is, the more pairs it can be exchanged for, the more useful it becomes as kind of a means of storing and transferring value. And we want this to happen across as many pools as possible, in both centralized and decentralized exchanges, and across as many chains as possible. And that's just kind of part and parcel of what happens when you build something that's a pure monetary asset. The more liquidity it has, the more exchangeable, the better, the more kind of ubiquitous it is across wallets and chains and pools, the more useful it actually gets to be as an asset. And that's something that sets it apart from things like governance tokens that have liquidity mining programs as well, and are getting very big in market cap and getting very liquid in market cap. Well, that's not changing the surface area of what you can govern with that governance token. And it wouldn't change the usefulness of a utility token either. So, say a token, it being more liquid doesn't directly improve the product. Whereas with a pure monetary asset, really, the more ubiquitous and liquid it is, more saleable it is, so to speak, the better it is. And so that's the kind of nice thing about Ample and liquidity mining and these AMM pools.
And I was going to say, I think the smart pools, and we'll have to see what the next generation of AMM design is. I think it's much better able to allow for price and market cap discovery. So I think the price of Ampleforth will behave a little bit differently than the past few months, where I think something like 40%. Evan knows the right numbers, but at least 40% has been running through Uniswap. And the issue with the current sort of constant function AMMs is that let's say that people really wanted a lot of amples, right? So the price in a centralized exchange would be high, right? Because people are expressing their demand for it. In Uniswap, the positive supply rebases are kind of treated like stock splits, so it automatically prices it much lower. So the impermanent loss there would come from liquidity providers who are then basically selling amples at a discount relative to what you would get it in a centralized exchange. But it also introduces this strange kind of forced price that's actually at odds with what the actual demand is. So I think as we get sort of the new generation of AMMs, and I think balancers, sort of smart pools is one of them, that the price will behave a little bit more like what we wanted to. And I think it also mitigates a little bit of the unfairness, right? Where, let's say that you're increasing the supply of, I don't know, sushi, right? And you're giving it to folks. The supply changes, but the AMM doesn't reflect that, right? It waits for arbitrage to move that. And I think with Ampleforth, that was kind of short-circuiting that natural kind of market functioning. So I think we're going to see a lot more arbitrage-driven price movements, which will kind of go back to I think what the original vision was for the project.
Yeah, that's a really nice way of putting it, Manny, actually. So one of the things that we didn't foresee when we originally designed the Ampleforth protocol was the effect of AMMs on price discovery. So, I mean, it's generally understood that things like the quantity theory are not really to be taken too seriously in the near term. Perhaps in the long term, it might hold true that as you increase supply, price goes down, and as you decrease supply, price goes up. But it certainly isn't expected to be true in the near term. But it so happens that on these AMMs like Uniswap, the quantity theory is in fact perfectly true in the near term, and that is often at odds with actual price discovery on order book exchanges. And the lack of variety there, in a way, in combination with the fact that so much of our volume happens on Uniswap, on these decentralized platforms, in a way short circuits true price discovery. And as we start to balance these things out with various types of AMM pools that are, suited for different needs and different kind of circumstances, I think it will be kind of a reversion towards a world that's much like what we originally imagined, where price discovery is a bit more natural. It's not a stock split where somebody turns off the market, intervenes, prices the asset, turns the market back on, and suddenly you have exactly twice as much of the asset valued exactly half, what it was before the split.
Yeah, it doesn't quite make sense even for like real commodities, right? It's like if we produced twice as many iPhones this year, or I don't know, twice as many apples, it doesn't mean that they're priced at exactly 50%. It's not a linear relationship like that.
No.
So
I mean, the moment a cow gives birth to a calf, doesn't affect the price of a cow on the open market. It's only when the new calves are put on the open market for bids over time that supply chain,
or even more dramatically, it doesn't half the price of the mother cow, right?
Yeah, no, exactly. It certainly doesn't. Yeah, but yeah, it's an interesting world.
Yeah, whenever people cite what is it, MV equals PQ, I'm like, what makes you think that the relationship here is linear? I mean, we don't actually know, and central bankers have. I mean, this is an equation from 1905, right? Or earlier than that, I believe, but no one has really used this in real economics for a long time. So it's funny that it's still kind of, it's found its way into crypto, but hopefully it will find its way out soon.
Yeah.
Okay. So just to kind of to recap again. So you mentioned that so for example this why, for example, the rebase, why Uniswap kind of doesn't sort of like treat the rebase correctly, because and you use the term price discovery, but am I right saying that Ample by design, it technically does not have price discovery, or like it's not supposed, or it only has price discovery within the
you could call it market cap discovery,
24-hour, market cap discovery. So like value discovery.
It has a supply discovery almost, right? So when price is above the price target, it's supply that's catching up. It's trying to get to this price supply equilibrium such that every unit of Ample is worth $1. but it's confused as to how many amples need to exist in the system, and it's only a matter of time before it finds out. And what we see in Uniswap is just kind of different. You know, it serves a very specific purpose. It doesn't really have price discovery. It kind of just has a constant product exchange formula, and it looks at the balance of these, the ratio of these balances to infer price. And that spot price isn't really a quote that any person is making or willing to sell a coin for. It's kind of just inferred. It's almost an infinitesimal representation of what an infinitesimal trade would represent at that given moment in time. And the way it discovers price, so to speak, is through arbitrage with centralized exchanges that do have these order books where, like, I can, you know, bid to buy 100 Bitcoin at this price, and then 200 at this other price, and then 300 at this other price. And you, like, you see those curves are always moving so quickly on those exchanges, right? It's changing all the time, and people put walls up, and it gets thin, and it gets wide, and it gets long. That's not really happening with Uniswap. It's just kind of a curve that's
yeah, the issue really starts to be felt when a lot of the volume comes from AMMs, right? Because they're not meant to be the vehicle for price, or in Ampleforth's case, demand discovery, right? They're supposed to just track, but you know, when half of it is happening there, it really kind of short circuits the system quite a bit.
Right. So okay, so do I understand then? And obviously, I think the kind of the crazy volatility in, I guess, so in Ampleforth, not in the price, which I guess the price as well, but in the sort of like the breadth of the rebases has also been sort of partially just from the kind of that it's just grown so exponentially, right? So so I guess, like, in the future, over time, this should sort of it should become a lot more mellow, right? That, you know, we're going to be talking about rebasing from like 1.05 back to 1 and so on, instead of 1.7 to 1, and leaving everyone in, like
I think there's probably
am I right saying that? Is that you know, over time it should, as it grows, it does get the market cap gets less volatile as well. Is that right?
In theory, yes, but I think financial history shows that you'll have a series of these bubbles, and each one will be quite expansionary. So, you know, it will be kind of changes in orders of magnitude. So yeah, I think after the last great big DeFi bubble, yeah, I think that the price will, you know, the volatility will be lower, but we might be a very different place than where we are today. Like, I'm actually quite surprised that we're having another sort of speculative moment just a few years after, you know, the 2017 one. I was thinking it might take, you know, 5 years, maybe more, but this is quite a blink of an eye in historical perspective.
People are hungry.
Yeah. Well, you know, there's also the this is a little bit of macro, some of the research that I'm currently doing at Stanford, but you know, historically, when you have big plague moments like this, you do have social unrest, you have supply shocks, you have inflation, but you also have monetization, and then followed by financial innovation. And I think everything today is happening much faster than the way it, you know, happened in Europe during the, you know, 13th, 14th, 15th century, or in China in the 15th and 16th centuries. And so it's, yeah, you know, there's a lot of fiat money, there's a lot of liquidity being created, everything's being, you know, a lot of transactions are being digitized. I think the digital commercial financial future is here. And so in some ways, I think the changes in DeFi are probably going to get wilder and wilder, I think so. I think it will be a long time. I would say it's probably like, I think the next decade will be quite volatile, I think, for most digital assets.
Yeah, I think to put it into perspective, in theory, over time, price will kind of stabilize. But I mean, that's true of Bitcoin too, right? Bitcoin, once it reaches full saturation, everybody who's ever considered buying a digital gold has had a chance to. It'll be less volatile, never to the point where, you know, it could really venture beyond the functionality of a digital gold. But, you know, that timescale is kind of what we think about in terms of Ample as well. I mean, the Ampleforth protocol is attempting to translate price volatility into supply volatility. And in our last run up, we saw that kind of happen. Like, at its peak, I mean, we grew from a $20 million market cap all the way up to a $1.65 billion market cap in a period of about a month. But from, you know, trough to peak, price went from about, you know, $1 to, you know, it hit $4 for a brief moment. So that's like a 400% increase, right? But really, we were talking a profoundly larger kind of market cap increase. And so it's just like a car that, you know, you're gunning, you know, pedal to the metal. The engine takes a little while to catch up. It punches you in the back, right? It's kind of like that. And you know, it might stabilize for a time until some structural change in demand takes place. And that might be driven by more macro factors, like what the Fed does or what the stock market does, and you know, how much money is floating around, like, and that's okay. So for us, like, for it to not be fully stable is perfectly fine. It should actually be able to expand and contract based on structural changes in demand. That's, you know, stability wasn't what broke gold under Bretton Woods. You know, it was this inability to respond to changes in demand. And so that is being kind of captured here with Ample. But I will say that I think over a long period of time, as Ample starts to stabilize, it will do so in a very different way than Bitcoin, where, again, you know, no matter how big Ample gets at steady state, each Ample will be approximately worth $1, and it might snap to the dollar price much more quickly.
I would say if you borrow, if you bought something for 100 Amples today, or, you know, got into a debt contract for 100 Amples today and then had to pay it off 10 years from now, I mean, you would be, relatively speaking, okay, depending on what the exchange rate is on that day. You would not regret it in the same way that people that bought, you know, pizza with Bitcoin later.
Right. That's a very good
right.
It's not like if
a very important part to
it's like if I owe you 100 Bitcoin
for like a newbie.
10 years from now, it's like, you don't want that. You definitely don't want that contract.
Yeah.
No. Like, not at all.
So I know we only got a couple more minutes left. You guys are incredibly busy. This has been a super fascinating conversation. Just some kind of quick questions to wrap this up. So obviously we discussed where Ample is today. What do you guys need help with the most from your community or from the world overall?
Memes.
Memes.
Well, sorry, I'll let Evan give the serious answer.
That's, I think, one of the best things to ask, I think, the crypto community.
Yeah, memes are a really great way to kind of encode insights into something that's, you know, visceral and emotional. But I think, you know, memes are a subset of education, right? We don't want misleading memes. We want ones that kind of, you know, bring you to that aha moment without forcing you to read, like, you know, a bunch of economics papers from the 70s, like Manny, right? I think the more we can do what we're doing with you here and have these conversations openly, the better, right? Because you're asking all the right questions. And I think that will kind of propagate into an audience of people who will then be able to encode it into kind of funny things.
Yeah, I would add on a more serious note, I think people that are developing, you know, DeFi protocols and tools, I think taking into consideration the elasticity of supply, which, you know, is now being copied across other tokens and projects being created, I think, you know, that I think would be fantastic for the ecosystem. It would, you know, would not only help Ampleforth, it would help, you know, Based and a few others. But I think making this a much more common dynamic, I think, just makes everything better. So I think in some ways, for people to look at the existing tools, kind of think about which ones don't work quite as they would want, and maybe just, you know, doing that. And I think the Ampleforth Foundation probably has some work, I think, that supports that. So I think getting the community more involved in building out tools and new features, I think would be fantastic. Building up that stack in some ways, so it's not just Evan and Brandon and team.
Yeah, Elastic Finance isn't just us, right? There's a lot of players now, and yeah, I think it will all help considerably.
Well, I think you guys have a lot to be proud of already. So just before we wrap this up, a couple of very quick sort of yes or no or very short questions to you. Will ETH 2.0 staking come out this year? What do you think? Yes or no?
No, I don't think so, but I am not an expert on it.
All right, and last one, if you had to describe DeFi in one word.
Just one
Oh,
word,
Take your
man.
time.
Yeah. Apolitical. I think that's more kind of aspirational, but it should be separated from politics.
Good one.
I was gonna say degenerate. I was gonna say I think
Also kind of accurate.
I think cyberpunk. I think it embodies the true spirit. I think of cyberpunk. I mean, the fact that we have anonymous devs launching things and all this other stuff. I think, yeah. So I would stick with cyberpunk.
Awesome. All right. This has been such a great conversation. I mean, eye-opening definitely for me. Intend to dig a lot deeper into Ampleforth. Thank you so much once again, Evan and Manny from Ampleforth for taking the time, and we wish you even more success for the coming years.
Thank you so much, and thank you for your time as well.
Yeah, thanks for having us. Really enjoyed it.